Okay, welcome to our deep dive into quality of earnings. We're going to navigate some ripoffs and some risks in business acquisitions. I'm Ted Leverette, the original business buyer advocate. For more than 30 years, I've been training and guiding people worldwide who buy small and mid-sized businesses. I'm not a business broker, never have been. I do not sell businesses. I do not represent sellers. Today, we're tackling the critical topic of quality of earnings, Q of E, in mergers and acquisitions, and specifically for small and mid-sized businesses. I'm going to try to guide you through the must-dos and the must-nots. I'm going to highlight the rampant issue of missing crucial information in too many reports. My insights might be startling or even upsetting for some people because I'm going to peel back the layers to expose hidden truths often overlooked in the acquisition process. Okay, so here's a heads up, 5 tips. Alarmingly, many acquirers are falling into the trap of selecting inadequate service providers or paying a premium for Q of E reports. Number 2, here's what you need to know above all else. Broaden your understanding of Q of E. Place equal, if not more, emphasis on future potential than past performance. Number 3, be discerning when shopping for Q&E reports. Insist on written assurances that the analysis will go beyond meeting lender criteria. So the Q of E report spotlights potential pitfalls and actually enhances your deal-making skills. Number 4, lenders want to know whether your merger or acquisition will handle debt service. So guess what? Lenders focus on loans, but you must live with the results. It's your challenge to evaluate whether you want to live the business ownership experiences to earn the profits, which are the basis for obtaining acquisition financing. And there's a big difference between earning profit, that's the financials, and living it, which is where the non-financials impact your lifestyle and peace of mind. Number 5, and for you cynics, most buyers lack the expertise to fully identify risks, and it jeopardizes the security of their investment, not to mention the lenders. Stay tuned because I'm going to elaborate on more tips, and you're going to get some of the best ones toward the end, so stick around. Okay, look, a quick note to the providers of Q&E reports. Rest assured, I am not in your lane. My job is to empower clients to effectively scrutinize your reports. That's the expertise I'm eager to share today and later. So let's ponder the essential questions. Why commission a Q of E report in the first place? When should you do it? Who should you trust to deliver it? What costs are involved? What risks are you facing? All that and more coming up. Okay, here are a few more tips. Now, this is a big dose of marketplace reality. Many lenders require buyers to obtain and submit a Q&E report as a condition of the lender processing an application for acquisition financing. And I'm sorry to say it, but lenders make mistakes. Well, let's say when lenders make mistakes, you get to pay for it. I'm referring to lenders who rely on inaccurate or incomplete Q of E reports, and then they approve your loan. Oh yeah, with your personal guarantee. So let's hope the lender requiring a Q of E report causes you to obtain it from a competent evaluator. Now, of course, ill-informed buyers are complicit when they too fail to comprehend the shortfalls of most Q&E reports. But that won't matter much if the business you buy cannot pay for itself. And then your bank expects to be paid no matter what. So with the right knowledge and approach, you can ensure a successful transaction that benefits everyone involved. Hey, and that's what you want, isn't it? Okay, so what is quality of earnings? How about if we be realistic? There are dozens of definitions, but the one I like the most is from Morgan and Westfield. They specialize in business sales, mergers, acquisitions, and valuations for privately owned businesses. I'm going to read what they say on their website. It's easily understood. A third-party analysis of the selling company's financial records prepared by an independent professional. The report verifies stated EBITDA, examines projected financial performance, and assesses to what extent revenue and earnings are sustainable. Other areas that are examined include quality of the assets, net working capital, accounting policies, debt and debt-like items, proof of cash and revenue, financial controls and reporting, adequacy of the management team, and here's the one that causes me to use them for the definition, quality of the supply chain. See what happened during the pandemic? There are other non-financial factors, but boy, we still need to address that, don't we? Okay, back to their definition. It's only another short paragraph. A third party is retained to prepare the Q&E report. The team is independent and has no stake in the game. So they are generally unbiased and not influenced by any pressure to do a deal. I like that. I hope you do too. Okay, so here's another tip. Don't risk errors and omissions. You and your service provider should evaluate every topic I cover today. Think of it as your checklist. Make some notes. I'm not kidding about that. Make some notes. Verify that your service provider will or will not address every topic I cover today, plus whatever else you need to know for your circumstances. Don't hire people without knowing the output you're going to receive. I'm going to say it again. Don't risk errors and omissions. Don't find out what you should have got after you pay for the report. I don't think I'd say it any more assertively than that. And I'm saying it because I see so much junk. So what about the providers of these reports? Well, the cost of the reports and the completion times vary widely, and so does the competency of providers. The range of pricing for various levels of Q&E reports mostly range from $5,000 to more than $30,000. And don't assume you get what you pay for by ordering from the most expensive service providers. Here's what a partner in a small investment company with several active small business holdings said about fees, and I know he's listening right now. The price point of a standard QofE report is so disproportionate to the typical deal size. So here's what I replied to him. Thank you for disproportionate. I've been losing sleep trying to find the right word among these possibilities. Now remember, we're talking about the pricing of these reports. Peculiar, excessive, unreasonable, extraordinary, irregular, too much, ripoff, criminal, and we're laughing out loud. Okay, be wary when service providers say you only pay them one time. And if that deal does not complete, they will not charge you again, no matter how many times you come back to them ordering a QofE report for your next potential deal. Hey, by the way, the same tip applies to lawyers and others who say they won't charge more, regardless of how many deals you want them to handle for you. And don't fall for the marketing pitch of I'm the best, I'm number one. You want the person who is best for you and your situation. The key word there is person. Do not let any firm's reputation blind you to the capability of whomever you're going to be interacting with. I'm going to reveal how some QofE service providers shortchange clients and why some lenders fund transactions that would be questionable if the buyers, sellers, and lenders had a more complete picture of the potential merger or acquisition. So, what kinds of service providers prepare M&A reports? Covering quality of earnings, of course. I'm going to list 9 of them, but keep in mind that your best choice relates to the kind and size of transaction and your locality. So who are these people? Well, accounting firms, consulting firms, subject matter experts, financial advisory services, investment banks, financial analysts, specialized financial due diligence firms, quality of earnings consultants, and last but not least, incompetent or troublesome sources. Hey, schedule a private Zoom with me. I can help you locate and evaluate service providers. I can help you interpret the reports. I can help you decide on the rest of due diligence and deal making. Because you see, if you get this wrong, not much else may go right for you because of how these reports influence you and how these reports influence potential lenders and investors. Oh, and the other side of your deal-making table, brokers, sellers. All right. Who wants or needs a Q&A report? Well, stakeholders. Who are they? Well, investors, lenders, potential acquirers. Oh, and savvy owners and sellers and brokers. They want QofE evaluations to facilitate M&A transactions. Now, these reports are not audits, and they're not comprehensive due diligence. So if you're considering applying for SBA loans, there's one important factor to keep in mind. They typically require a personal guarantee and maybe a QofE report from a provider acceptable to the lender. Let's talk about some issues that are inadequately addressed. Now we're going to dive into some of this nonsense. Unfortunately, the problems I'm going to first state, these are the ones you probably are not going to know about, such as overpaying for the reports or buying reports that don't cover as many topics, especially the essential topics that are included in the reports from the alternative or the better service providers. And then, of course, we have the typical issues that we hope are adequately evaluated, like accounting anomalies, cash flow concerns, accruals and adjustments, and deviations from industry norms. Too many users of Q&A reports do not realize the financial statements to a large degree are directly influenced by non-financial factors. You know, the kinds of forces that create the financial results, that inform the forecasts. Closely follow up with report writers who say something like this in their reports. It cannot be determined if, whatever, which means they did not cover it. Oh, and this kind of disclaimer, we do not represent that our report is sufficient for the customer's needs. Well, you better find out why and what you can do about it. See why we want to see written sample reports before you spend the money to get a report? Okay, we'll come back to that slide. Common errors and omission. Beware of the potential mismatch between what lenders will evaluate and the content of Q&E reports. Some loan brokers and lenders upfront give applicants for financing the list of topics the applicant must address. I've compared those lists with the typical content of Q&E reports, and guess what? It's not a pretty picture. So let's consider some issues not addressed or not adequately addressed in lots of Q&E reports. I'm going to cover 15 of them. You're going to even get examples here. If you're not note-taking here, I hope you will find a copy of this someday if I ever publish it. You need to get this right. Number one, overlooking non-financial factors, such as economic and other trends, management, operations, competition, and relationships with stakeholders like what? Customers, employees, landlord, banks, suppliers, that kind of stuff. Those are the non-financial. That's number one for a good reason. Number two, Q&E analysis should reveal hidden liabilities and contingent obligations. And these are things that are not adequately disclosed in the financial statements. Things like, pending litigation, warranty claims, or environmental liabilities. They can have a huge impact on the company's financial position and its future cash flows. Number three, inventory reporting, such as valuation, tracking the amounts, the usefulness, the turnover. This topic, inventory, can be a major cause of arguments and time delays when accountants, lawyers, and appraisers are doing their thing. I know some of you are smiling on that one if you've done a deal. Number four, failure to identify inappropriate accounting policies and practices, such as compliance with accounting standards and accuracy in reporting. And keep in mind how comparability of the numbers within the target company and against similar companies. Number five, accruals and adjustments. Hey, watch out for the discrepancies with accrual and cash accounting. Large and unexplained accruals or changes in accruals may indicate earnings manipulation. Number six, omitting comparative analysis. Deviations from industry norms or peer performance that could signal underlying issues. I see this all the time in due diligence, by the way. Number seven, improper revenue recognition, such as, too early, too late, not related to the subject company, or it's not reported at all. Why? Because of skimming. Number eight, overlooking non-recurring revenues. Number nine, neglecting macroeconomic factors. Now, things like external economic conditions, interest rates, inflation, availability of capital. Remember what happened in the Great Recession? Okay, number 10, incomplete financial analysis, such as the changes in revenue streams and the streams of expenses and cash flow. Number 11, neglecting expense analysis, such as the relationship between variable and fixed expenses. I almost never see that, and it's a huge mistake, such as the relationship between variable and fixed expenses. And also, you need to detect non-recurring and the extraordinary. You got to look for consistency and appropriateness, all in the expenses. Hey, what about failure to accrue for future expenses? Or how about excessive discretionary spending? You know, that old discretionary, those adjustments. Don't forget, expenses not related to the subject company, which happens when another entity is paying the subject company's expenses, and you may not know about it unless you discover it. Due diligence in QofE is a good time to handle that one. Okay, how about number 12? Inadequate cash flow analysis. You know what happens there. It can mask what? Liquidity problems. 13, failure to consider industry-specific factors such as regulatory, technological, or competitive. Competitive. You remember what Warren Buffett says, one of his rules, he looks for sustainable competitive advantages and he tries to do it before he buys companies. Number 14, what about management integrity and governance? I mean, skimming would be an example of that, but there is a lot of others. How about this? Conflicts of interest, related party transactions, or inadequate internal controls. These issues can erode investor confidence and affect the company's reputation and its valuation before and after you buy it. Number 15, last one on the list, owner distributions. Are they reasonable? And are they legitimate? Now, those errors can enable an inaccurate assessment of a company's quality of earnings, and this is not good for buyers. It's not good for lenders. It's not good for anybody. Let's talk about the difference between diligence and quality of earnings. Well, the doer, in other words, who's doing the work. The focus, who's focusing. The scope, what's the scope? The details differ in QofE and formal due diligence. And here we're talking about the comprehensiveness. And what's really important is to what degree are the non-financials being covered? How deep? Are there interviews? Or are you simply taking the word of the seller or the broker? What about legal? What about market research? There are lots of other risks and opportunities. So you go much deeper in all of those things in formal due diligence, but some of those, most of those, you'd be wise to have it handled in QofE. Actually, it'd be wise to have it handled before you pay money to anybody. That's what I have my clients do. We look into this stuff before we hire a QofE report, so we have some idea of what it's going to be, so we don't have to buy 2 or 3 of them. How can I say this? You need to know how to allocate the work. You do work, your advisors do work, your providers and vendors do work. The allocation is huge. It'll save you time and money if you do it right. Remember, they're supposed to facilitate due diligence. These QofE reports are supposed to help you with due diligence. A couple more points. QofE analysis, as done by some of the less helpful service provider, they merely help you identify some discrepancies or the risks that are so damn obvious. And they're actually spending most of their time looking at historical and only the financial statements. This is absolute nonsense. QofE analysis does not, if it doesn't handle the non-financials, you better get it done during the rest of due diligence. Okay, how about some CYA? You know what CYA means. Cover your ass. It also means cover your assets. Learn more about best practices, about risks, about mitigation, timing, providers, and broken deal fees and arrangements with your advisory team. Don't believe you're getting a good deal from advisors who say, pay me once for one potential transaction, and then if it falls through, you don't have to pay me again no matter how many potential deals in which you want to involve me. Shop around when it comes to finding the right provider, particularly of Q&A reports. 3 tips. See samples of their workmanship. Verify their credentials. And whether or not your lender is going to accept their report. I've seen people buy these reports and lenders don't accept them. Then you get to do it again. Okay, here's another tip. Begin with your target pre-tax net cash flow requirement and express it annually and monthly, like trailing 18 months or something. And then, this is how you save time and money, screen businesses that are for sale on their non-financials. They're non-financials, because you see, these non-financials are going to answer the who, what, where, when, why, and how. What is skimming? Well, here's what skimming is. Skimming is when an owner let's say you have a laundromat or a car wash or any company that gets cash other than check or credit card, for example, and they just don't, well, they may deposit it, but they don't deposit it in the business's bank account. They deposit it somewhere else. So the financial records don't report that. So if you're trying to buy a business and it's known for skimming, and an owner says, look, it may show I'm making almost no money, but I'm actually a millionaire because of it. My advice is to run like hell, because if anybody is cheating the government for taxation purposes, you think they might want to, what, cheat you? Because it's so easy to skip this one. Omitting comparative analysis. And what I said was deviations from industry norms or pure performance that could signal underlying issues. So we're talking about comparing financial, let's say balance sheets and P&Ls with other businesses in that sector. And there are lots of databases that you can access that can show you that. If you're only looking inside a company and its history, that is really naive. Any size of company not needing a QofE or always get, all my clients learn to do the QofE themselves. Some do it, some do a lousy job of it, some don't do it at all. Somebody needs to tell you, the buyer, as well as the lender, about the quality of earnings. So if you're not going to do it, you need to hire somebody. I've already talked about what goes wrong when you're hiring somebody, because it's no fun paying for a report, 3,000, 5,000, 10, 20, 30,000 bucks, have the deal fall through. Sometimes it falls through at escrow when the bank that week says, you know what, we decide we're not going to fund this deal. Oops, all that money you threw out for your advisor team is down the drain. So you always have to get it, but you can do it yourself. If the lender requires it, well, that's the only way you're going to get the loan. As a buyer, what steps can we take after the LOI before hiring a QofE consultant? Well, don't forget, before the LOI, if you go to my website or my YouTube channel, you'll see I have lots of stuff about pre-LOI due diligence. You handle the easy stuff in pre-LOI due diligence. You handle it yourself. Don't pay anybody. My clients, they do the work. I show them how to do it. I hold their hands, but they do it because it's their life, their investment. They really need to be intimately involved in the business from the get-go. Now, right after the LOI, that's when you can do as much due diligence as you can. Go to my website, partneroncall.com, because I just added 2 new pages about how you can allocate the work you do before you hire anybody. And the whole idea here is I've seen clients give up their search for a business because they're 40, 50, 80,000, 100 grand into lawyers, accountants, appraisers, and QofE people. And now they don't have enough money for a down payment, or they're so scared they're afraid to hire another report. I've already had 2 people who are not in attendance of this program contact me, who are in the QofE report writing business, who have said to me, would you be willing to review one of our reports confidentially? Because we need to know if it's a green light, yellow light, or people like you are going to pan them. And yeah, I do that. I think what you're going to find, those of you who got Q&E proposals 2 weeks ago, I hope you didn't hire anybody, because when this word starts getting out, you're going to find people doing the QofE reports, and they're going to be adding to their website stuff that they know you need to see, and you're going to see the text change that covers some. How do I know this? Because I ran a business appraisal company for 20 years, and I really tried to clean up the appraisal business because it was just such nonsense way back then. Nowadays, we got lots of high quality appraisers, but in the good old days, there was a lot of crap. Same in business brokerage. You know, I'm kind of infamous for making comments about brokers. Critical, but I say lots of nice things about brokers because in the last 20 years, their whole industry has gotten so much better thanks to their trade associations. Now, that's the United States. In Canada, pretty good. UK, I see all you UK people, you know, not so good. Brokerage, very questionable. Down in the Aussie land, there are some absolutely wonderful business brokers, and same in New Zealand. Okay, folks, schedule a private Zoom with me. I can help you locate and evaluate service providers. I can help you interpret the reports. I can help you decide about handling the rest of due diligence, showing you how you can do some work so you don't blow money and time on people doing work for you. Because I said it earlier, if you get it wrong, not much else goes right. By the way, I can help you through the use of the tactics and strategies explained in my books, how to prepare yourself and find the right business to buy. In my other book, How to buy the right business the right way. You can get them on Amazon, and you can find me at my website, partneroncall.com. Oh, one more thing. Fair warning, mistakes made on the playing field may not be reversible. As they say, we cannot unscramble eggs. I hope this has been useful. I hope you can see the opportunities and risks with QofE. So I'm Ted Leverette, the original business buyer advocate. Thanks for listening, and be careful out there.
Hey, you. That's right, you. Have you been looking to buy an exciting and profitable business? Are you tired of searching, but only finding barriers that impede you from owning a wonderful business? Well, have we got some good news for you. You can find and buy the right business the right way. And you don't have to go it alone. For over 30 years, author and transaction advisor Ted Leverette, the original business buyer advocate, has been helping buyers worldwide achieve win-win done deals. Ted Leverette says, you can't buy it if you can't find it. You see, buying a business is all about search. Because if you can't find it, you can't buy it. It's about being best and first. First on the scene with sellers, and being the seller's first choice, and top of mind for brokers and sellers. And most importantly, avoiding buyer competition. What about having to compete with other buyers? Well, you have to outbid them, which is a good way to pay more than a business is worth. Searchers do better with a winning business buyer marketing plan, and that's where Ted Leverette comes in. He'll help you prepare a winning plan, and then he'll guide your actions so you can find and then buy the right business the right way. But searching is not enough. The reality is too many people buy the wrong business, or they buy the right business, but on the wrong terms. That's why, if you want to buy the right business the right way, it makes sense to have Ted Leverette, the original business buyer advocate, on your advisory team. And one of the best ways to know what the savviest searchers and buyers do is to read Ted Leverette's books, How to Prepare Yourself and Find the Right Business to Buy, and How to Buy the Right Business the Right Way. You can get them at his website, partneroncall.com. Don't chance it. Right now, go to partneroncall.com, get the books, and schedule a free and private telephone conversation with Ted Leverette.